So, hi everyone. In continuation to our other substantive audit procedures, today we will be discussing the audit procedures for the contingencies, which are litigations, claims, and assessments. So, let's see what we understand here, what's the concept of this, and let's get connected again. So loss contingencies need to be disclosed if that is reasonably possible or probable, but it is not estimate. Also accrued if probable and reasonably as estimate. So there are different categories of the loss contingencies, such as they may be remote or reasonably possible, that may be probable and non-estimate, and that may be probable and reasonably estimate. So in all these four categories, there are different criterias for disclosing and accruing those contingencies as mentioned in the table. So if that is remote, disclosure and accrual both are not required. If it is reasonably possible, then the disclosure is required. If it is probable and non-estimable, then disclosure is required. And it is if it is probable and reasonably estimatable, then disclosure and accrual both are required. So what is the audit procedures for this? So first, it is to identify the litigation, claims, and assessment involving the entity that may give rise to the RMM. So audit procedures may include inquiring with the management and others within the entity. First is the inquiry, and then obtain from the management a description and evaluation of the litigation, claims, and assessments as at the date of the financial statement being reported and during the period from date to the financial statement to the date into the furnished. So as on the date and all the movements in those litigations. Also inspect the minutes of the meeting, correspondence between the entity and the legal counsel, contract, loan agreements, leases, correspondence regarding those legal things, and other documents for the possible guarantee by the entity. Also, inspection of the legal expenses should be done. Confirmation from the bank should be obtained in regards to the litigations. Also, if the actual or potential litigations or claims and assessments are identified, then auditor should obtain audit evidence relevant to the following three factors: the period in which underlying cause for the legal action occurred, the degree of the probability of an unfavorable outcome, and the amount of the range of the potential loss. So these three should be assessed when identified. Also obtain the management representation and narrator. So auditor should obtain MRL, knowing all the possible and actual litigation, claims, and assessments whose effects should consider when preparing the financial statement. So the management representation letter is also required in the case of the litigations are found or identified. Proceeding forward, communication with the entity's legal counsel. So auditor should also communicate with the third party who legal counsel who is involved in the litigation solutions or litigation discussions. So letter of the inquiry to the external legal counsel and in-house counsel. So external as well as in-house counsel, whoever are involved, so letter of the inquiry should be sent to all of them. Letter of inquiry to be prepared by the management and sent by the auditor. So point to be noted is that it should be prepared by the management and auditor should send through their own email ID. Requests the external legal counsel to communicate directly with the auditor. So required unless procedures indicate that the no actual or potential litigation, claims, or assessments that may give rise to RMM exist. Similar letter of the inquiry to seek the direct communication of the auditor with the entity's in-house counsel. So, however, audit evidence obtained from in-house counsel is not a substitute for the auditor seeking direct communication with the external counsel. So, both inquiries should be required from in-house as well as external, and one cannot be compensated with the another. Though through the letter of the inquiry, auditor requests entities legal counsel to inform the auditor of any litigation claims, assessments, and unasserted claims that the council is aware of. Also, assessment of the outcome of the litigation claims and assessments, and an estimate of the financial implication, including cost involved in that. Also, it is preferable that the entity's legal counsel response date be as close to the date of the auditor's report as practicable. Also, if auditor does not seek the direct communication with entity's legal counsel, need to document the basis for such determination. Whether the auditor is aware of the when auditor is aware of that an entity has changed the legal counsel, or the legal counsel previously engaged by the entity has resigned, the auditor should consider making inquiries of the management or about the reasons for the changes. Also, in some circumstances, legal counsel may be required to resign if entity disregards the legal counsel's advice concerning the financial accounting and reporting for the litigation claims and assessments. So, auditor may modify the opinion if either the entity's legal counsel refuses or management refuses. So if the entity legal counsel refuses to respond appropriately to the letter of the inquiry, and auditor is unable to obtain sufficient appropriate audit evidence via alternative procedures, so here scope limitation leading to the qualified opinion or disclaimer of the opinion should be given. Similarly, if the management refuses to give the auditor permission to communicate or meet with the entity's external legal counsel, then in that case, management imposed scope limitation leading to the disclaimer of the opinion should be given. Also, if the legal counsel is unable to respond because of the inherent uncertainties, opinion may be unmodified, but with the emphasis of the matter para provided, the uncertainty is properly disclosed and auditor was able to obtain the all other requisite information on the time. So these were the audit procedures for the litigation or the claims that existed in the entity's financial statement. So further discussing another topic of the other audit procedures, we will be discussing the estimates and the fair value measurements. So estimates is something based on the judgments and it requires the special consideration while auditing. So let's go through it and let's understand what are the audit procedures for the estimates and fair value measurement. So accounting estimates, which include the fair value accounting estimates, which are made by the management. So financial statement which cannot be precisely measured, such as allowance for the doubtful debts, warranty obligations, inventory obsolescence, and also the fair value accounting estimates such as assets, liabilities, goodwill in the business combination, or share-based payment, discontinued operation. These are the examples of the fair value accounting estimates. Talking about the nature and reliability of the information available to the management to support the making of an accounting estimate varies widely, which thereby affects the degree of the estimation uncertainty associated with the accounting estimates. So in turn, the degree of the estimate uncertainty affects the RMM of the accounting estimates, including the susceptibility to management biasness. Few of the examples of the accounting estimates that may involve the low uncertainty are accounting estimate arising in the entity where business activities are not complex or frequently made and updated, frequently change in the market price, like frequently change in the market price. These are the examples of such incidents. However, some of the accounting estimates which are relatively high estimation uncertainty may exist, that depends upon the judgment, the calculations, and the highly specialized entity models. These are the few of the examples of the scenarios where the estimations are of the high uncertainty. So here the objective of the auditor is to obtain the sufficient appropriate audit evidence about whether accounting estimates, including the fair value estimates in the financial statement, whether recognized or disclosed are reasonable or not, and related disclosure in the financial statement are adequate or not. So these were the objectives of the auditor in the estimating the fair estimations and the fair value measurements. So discussing about the audit procedures for the estimations and FBM, risk assessment procedures include obtaining the understanding of how management develop the accounting estimates, evaluate the degree of the estimation uncertainty associated with the accounting estimate, The auditor may also consider the following matters such as actual or expected magnitude of accounting estimates, recorded amount of the accounting estimate, whether the management has used a specialist or not, and outcome of the review of the prior period accounting estimates. Similarly, further audit procedures may include the management process to be reviewed and tested, independently developing the estimate, subsequent events to review to determine the estimates are reasonable or not, management biasness, evaluating the audit findings, and audit documentation. So, talking about the management processes to be reviewed and tested, auditor should evaluate whether the method of the measurement used is appropriate in the circumstances or not. Assumptions used by the management are reasonable or not. So, here, auditor should be attentive if assumptions are subjective or deviations from the historical pattern exist. Also, auditor should independently develop an estimate and compare to the management point of the estimates. Auditor may perform the subsequent events to review to determine if the estimates are reasonable or not. Auditor should also review the judgment decision made by the management in making the accounting estimates so that biasness is there or not may be known. Evaluate the audit findings. Auditor should evaluate whether accounting estimates are reasonable or misstated and related disclosure are made in the financial statement or not. And regarding the documentation for accounting estimates that give rise to the significant risk, the basis for the auditor's conclusion about the reasonableness of the accounting estimate and their disclosure should be noted, and indicators of the possible management biasness should be noted. So these were the audit procedures for the estimation and a fair value measurement. So these two topics are covered in the today's session, and the next topic of other audit procedures will be covered in the next session. Also, please let me know if you have any queries in the comment section, and I will help you to resolve those out. Bye and take care.